Welcome to Old Fashioned Finance, the podcast that mixes cocktails and high finance. I'm your host, Caleb Frankert, and I'm joined by my good friend and fellow money muddler, Jason Brunell.
Caleb, can a podcast about finance be entertaining?
Not without alcohol.
All right, let's mix it up. Yeah.
Hey.
Drinking time.
Yes, the best time of the week.
Yeah, one drink a week. That's pretty much what we got.
This is it, folks. This is the only time we do this.
We give very much false impressions about how much we drink.
You take that for, if you're listening. Someone's listening. Take that however you will.
Exactly.
We may or may not drink more or less than one drink a week.
Yeah, I don't drink very much, but...
All right, buddy.
I'm excited,
This has been one that we've talked about for a long time.
Yeah. It's coming up a lot right now.
It's a long time coming on this one, right? I don't know. I'm not. Are you excited about this one?
Yeah, I mean, I think it seems to be you get market turbulence going and people start asking the questions.
Yeah.
And this is one that I think as a financial advisor, we have to defend
Definitely.
than explain.
Yeah. Well, I think you hit it there. Defend because, instead of, let's not ruin it.
Yeah, here we're jumping in. This is like minute 20 stuff.
Okay.
We start getting into controversy about minute 20.
Defend. Yes. Something we have to defend. Okay.
Yes.
Let's get into the drink. Today, Jason, we're drinking the Man-O-War.
Ooh.
Yeah, what do you know about this one?
I don't know.
Other than just mixing it up.
looking at the ingredients, I'm about 75% bought into this.
You have a preconceived notion that you are going to like this drink.
I do, but I'm concerned about the lemon juice.
Yeah, so okay, the Man-O-War. Let's get into the ingredients here. I don't have a lot of history on this one. There is history. I just didn't look at it. So I thought it was a cool looking drink. I picked this one because of how cool it looked online.
Yeah,
it's a very cool looking drink online.
Yeah, I did. It looks like pee in a glass.
I was going to say it looks like dirty river water.
It looks like you need to hydrate a little more.
Yeah, it's not as pretty. Although there was like kind of romantic lighting in the picture online. So
well, and my mind instantly went to nature and the Portuguese Man-O-War.
Yeah,
and
which is basically a jellyfish, right?
It's a really nasty jellyfish. So yeah, so I don't know. It's not blue or clear. No. Again, I think it looks like river water. Okay.
It tastes better.
I get behind that.
But here's the deal. Here's what's not in river water. 2 ounces of bourbon.
Yeah.
1 ounce of orange Caraqueo or triple sec. We used Contro. Yeah, if you have the option, use Contro. 1/2 ounce of sweet vermouth. That's the red kind.
I had to be reminded. I think he's subtly making fun of me.
No, never. And then 1/2 ounce of lemon juice, which I feel like is taking over the color here.
Yeah.
We garnish that with a lemon peel and a Luxardo cherry.
Of course.
Kind of like a lot of these Manhattan-y kind of drinks. And I know this isn't totally a Manhattan-style drink, but, you put all that stuff into a shaker with ice, shake it up, strain it into the glass. Yeah, it just didn't come out as beautiful as I thought it would. But let's cheers and take a sip. Maybe it'll surprise us. All right. Citrusy.
Yeah. You know what? I'm disappointed.
It's really lemony.
Dang it. I really wanted it to be good. Let's just face it.
You know what it reminds me of a sidecar.
Yeah, definitely. There's a lot of citrus in this. And lemon it's really overpowering.
Yeah, so 1/2 ounce, and that's what I'm tasting.
Yeah.
Smack right in the face. I'm getting a little bit of the orange Caraqueo or the Contro. Not much of the bourbon. This actually, something that has been on the list of drinks to cover is the bourbon sidecar. We did a sidecar way back, a long time ago. I forget what episode that was. But this is probably in that same, because the sidecar had gin, vermouth of some kind, and lemon juice and Contro. So, this is probably real close
to a bourbon
sidecar. Very lemony.
Yeah.
A little bit of lemon juice goes a long way.
Yeah. Yeah. Not my favorite. Not for me, dog. So
it's sour. And I have a little bit of a chapped lip today. So.
Ooh. Yeah. I don't know. I mean, I think, like looking at this, I'm like, I think we just want to drink Manhattans.
Yeah.
We're like, ooh, I'm excited.
We need to
about
get
this.
back to a Manhattan Project or something like that. Actually, this would have been a great Manhattan Project, active and passive investing.
Oh, what the heck?
Anyway, yeah.
Who designed this one?
Reading the ingredients: 2 ounces of bourbon. Yep. Contro. Yep. Sweet vermouth. Yep. Lemon juice. Just a little bit. Okay, so that's I don't know. This turned out a lot different than I thought it would.
I'm disappointed.
It's all right, but we're drinking bourbon on a Wednesday afternoon.
Yeah. At work.
Yeah. I guess that's a good segue to just jump into the finance topic here. So, Jason, we're talking about active versus passive investing today.
Yeah.
Are there any opinions out there on this?
That lemon juice is very active in this cocktail.
It is.
Yeah.
It's definitely not a passive ingredient in this one.
Oh, we did it.
See how we did that?
Oh, gosh.
We're smart.
That wasn't even planned. There are tons of opinions about this. Tons.
Yeah, absolutely. Let's go back to what we talked about before. As financial advisors, this is where we kind of start to defend.
Yes.
Right?
Definitely.
Explain yourself.
Well, I think there are few principles in investing that I would say you like really stand your ground on. So I think people mistakenly stand their ground on this. And there's periods of time where it really, really works well. And there's periods of time where active versus
either side.
Yeah, either side. Yeah. And there's periods of time where, it doesn't. So I think that recent history always seems to, complement one of these strategies more or less. And so I know I'm just kind of talking like a politician right now, but principles like diversification, right? I'll stand my ground on that one. Firm-footed, not going to change.
But I think passive investing, and that's where it does start to muddy the waters a little bit, kind of like this muddy water looking drink that we have.
Oh, there we go. Yeah.
Is you can diversify while using both active or passive strategies.
You can.
Right?
Yeah. And so, but the problem is, I think, is what you start to build too many of those investing principles without any kind of leeway. I think that's when you get in trouble. So there's tons of opinions on this, and we can have cage matches over this one, I think.
And we will later. Let's jump into really, I guess, for listeners out there who are new to this, maybe have heard it brought up, active versus passive, and it's one of those like, sitting at the bar and I'm drinking my Man of War here and just nodding when I hear the conversation, active versus passive. So if you haven't gotten into this a whole lot, let's talk a little bit about let's start with active. Okay. Jason, what is active investing, or what's an active investing strategy versus passive? What does it mean to be active?
Yeah. So you're going to change things up. So there's some flexibility in there. You're probably going to not stick to a strict investment objective. Okay. And so a little bit more trading. I think that word trading kind of comes into my mind when I hear active. It's kind of opportunistic, tactical. I think that's a way of saying you're just looking for opportunities in the market.
So I would say active investing. What active investing means to me would be the idea of, and I think this is what a lot of folks imagine when they think of a financial advisor. They think of active investing, right? Someone who's making trades on a daily basis, who's looking at charts and fundamentals, and even technical analysis, but picking stocks, right? Right. Instead of just riding with an index, which would be kind of the passive
argument.
So without jumping into what is passive, going out and actively stock picking, and like you said, having the flexibility to manipulate the allocation and be opportunistic and things like that. So
and I don't think by any stretch of the imagination, our thought when it comes to active is like trading.
Yeah.
Okay.
That doesn't mean that we're just someone's behind the scenes pulling a bunch of levers.
No.
Day trading.
I think portfolio. Of the Great Wizard of Oz. Kind of like what's behind the curtain.
Yep.
But an active investment strategy can be driven by an algorithm, for example.
Boy, let's make people fall right asleep and talk about the algorithm.
Oh, dude, that's like you're like that's just I love that stuff.
I know you do, but
I'm such a nerd. Anyway, but in other words, there could be math behind the scenes, picking specific opportunities in the market.
So It is very simple. It's not as simple as, well, active means that we're trading and picking, and passive means we just sit back, because neither of them are that simple. But really, the big difference is there. I guess active would have more of an emphasis on not just stock picking, but like you said, even an algorithm or the objective of a fund or something like that would be more tailored, I guess.
Yeah, and it might be like, I'm thinking of ETFs or mutual funds that are like seeking companies with great balance sheets, and then they go down through like balance sheets, debt ratios that are low, outstanding share. Like you can go through like some things and actually get to a pile of companies, and that would be considered active.
It's kind of old-fashioned fundamental asset selection. And so I think anybody that understands mutual funds, which we've talked about here before, think of the old school, old-fashioned mutual funds, right?
Yeah.
Passive investing didn't come around till 1976?
Sure.
Jack Bogle, Vanguard.
Right.
And it's been, gained momentum ever since. But yeah, the traditional classic mutual fund was this, paying a fund manager to go out and actively pick the holdings based on
an objective.
Really,
an investment objective.
Right. Could be lots of things. Could be hair on fire growth. Could be dividend
income. It could be. So there's lots of reasons there. So
I think this is the classic investing that we all think of. So
I think that's a good way of looking at it.
Probably what most people think of when they think of portfolio management.
Right.
I would say. So
exactly.
Let's run down the list of pros and cons. We've sort of highlighted. We've touched on some of these, but pros of active investing, Jason. You hit it, flexibility, the ability to change course within a strategic objective, within, right?
Yep.
The
might
ability
be a person driving it, but it also could be math.
Yeah. Yeah. So the flexibility, I think, is the big one.
Yep.
And like you said, the ability to be tactical, strategic about your changes in the portfolio, and to be opportunistic. So the upside, or the big pro, I think historically would be the ability to maybe outperform indexes, right? Instead of buying everything, we're going to go out and pick the most solid companies that should win and outperform, right?
Yep.
We can get into commentary about whether it happens or not.
Right.
But let's flip sides and look at the cons. So you get more active management.
Yep.
One of the cons, and I think probably the biggest one that's thrown out there, is the extra cost.
Absolutely. And whether it's built in cost to just having the fund manager, running the money, or just the trading expense. Folks, trading in the stock market isn't free.
Right.
So, there's costs associated with that, potential tax situations, by buying and selling and experiencing cap gains. So yeah, more expensive is common.
You're getting more hands-on, so you would expect to pay more. The other con, that this would be the second one I think that gets thrown around. Maybe it's the first one.
It's probably the first one.
Which is, we just talked about one of the pros being the ability to outperform an index. The problem is it usually doesn't happen.
It's hard.
Or for most fund managers, they don't beat the indexes, historically speaking.
It's difficult. And are there funds out there that do it? Oh, sure. That's where, I think folks get caught up in picking the investment too often and less in picking what part of the market they should be invested in.
Yeah.
Okay. So that's that asset allocation versus investment picking argument, which is a whole nother episode waiting to happen.
Absolutely.
But, it is difficult, and it takes a lot of effort to find those managers that are consistently, or maybe not even consistently, have the propensity to outperform for whatever reason.
Well, and a lot of it depends on the time frame that you're looking at too.
Yeah, absolutely. Yeah.
So we talked about what is active investing, what are the pros and cons. Let's do the same for passive. So what is passive investing, Jason? Is it as simple as just buying an index?
Not really. Again, you could just buy an index fund and hold it forever, and probably get close to the average return of that index over a long period of time.
Yeah, and I think the argument is, you do that, because there's not active stock picking going on, the expenses are much lower, so you should return relatively close to what an index is going to perform long term. Now, there's some other factors that go into that too.
There are factors. And so, again, there's two sides to passive investing: picking an investment and sticking with it, but also the asset allocation is part of this. So yeah, I could argue, and we could argue both ways on this, active versus passive.
We'll have that time to talk about what we think.
Exactly. So some of the pros, you're looking at those. It's just like lower fees. You just said
Right.
it. You know, the holdings are very, very clear.
Yeah, you're buying
the index.
an S&P 500 index fund.
Right.
You got a pretty good idea of what you're holding.
Right.
I mean, your holdings aren't going to change based on your quarterly report like it might in an active strategy.
That's right. That's right. And that's the next thing, you know, the tax point. I mean, you're the tax dude.
Yeah, I mean, passive investing can be very beneficial in a non-qualified account.
Yep.
Because you're not changing holdings, you're not turning over your holdings on a regular basis. You're not triggering those capital gains.
Right.
So, you know, again, when we get down to what do we think and what makes the most sense, this is like a lot of our episodes. Well, depends on the situation.
It does.
So there are a lot of advantages. Lower fees. You know what you own. Again, from a tax advantage strategy. Now we could flip this around and go back up to active investing and say, is that a pro too? Well, it could be with an active fund manager,
especially in a year where the market's sold.
Right. You could look at part of the strategy of active investing could be tax loss harvesting and things like that. So, but I think those are the big ones: lower fees, knowing what you own, and the tax advantage. And again, I think from a performance standpoint, you should be able to mirror or get close to what an index is averaging. So let's flip over to cons. What's not great about passive investing?
You know, again, that flexibility isn't there, but I'm actually gonna put just a little different twist on this.
Okay.
And it's managing emotion. Like,
yes, I think I know where you're going.
Yeah.
Keep going.
So I have a passive investment strategy.
Mm-hmm.
I see the chart, and then my teeth get knocked out of my face
You're
when the
feeling
market
the
sells
pain.
off 30%.
Yeah.
Like this year, the NASDAQ,
Right.
I mean, it's really been damaged.
Mm-hmm.
And so you have to be able to get through that.
Right. So if you're just holding an index that, like you said, got its teeth kicked in this year, and you don't have the fortitude to just, you know, throw the statement in the drawer, not log in and check your performance on a daily basis, and not live and die with those numbers, right, you probably have to have a little bit more intestinal fortitude to hang on, because on the pro side, you should be able to return what the index average is or darn close to it.
Right.
But on the con side, also, when things are selling off, you don't have a buffer. And, you know, I think that's a huge case, you know, when we're defending active management. Nobody wants to be down.
No.
You really don't want to be down as much as the markets are. When the markets are down, you wonder, what am I paying for?
I have only met a very small group of investors who have the emotional fortitude.
Mm-hmm.
And I know that when you get started, and let's say you have $10,000 in the market and a 30% correction comes along, that's $3,000. So your 10 is now 7,000, right?
Mm-hmm.
Add some zeros to that. Make that $1 million.
Yeah.
Okay. And a 30% correction comes along and $300,000 just disappeared from your account. I don't know very many people who wouldn't be like, that kind of hurt a little bit.
We do this for a living,
right?
And we preach it, and it's still, I think it's easier for us to, because we're more worried about other people's money than we are our own most of the time.
Yeah.
But, you know, we take a look. There's times where I go, you know what, out of curiosity, let's take a look at oh, crap. Let's not look at that again.
Yeah,
right?
Exactly. Take our own advice.
But, and again, you know, we've talked about this before. Sometimes we have to preach to ourselves here with holding on and looking for opportunities to buy. So this is one of those cases where passive investing on the downside, you don't have the flexibility to pivot and say, okay, we've sold off. Now,
right.
how can we be opportunistic?
Exactly.
Well, if we're holding an index, we're just waiting for it to go back up.
Yeah. And so like the large cap value space might be outperforming the mid cap core. And so you can't pivot out of, if you've picked an index that's serving part of your allocation. Yeah, you're right in or die.
Sometimes it's right and die.
Yeah, exactly. And so you might get hit in the teeth pretty hard. And you know, we didn't talk about this earlier either, so I'm going to point out another thing.
Mm-hmm.
There are 9 gazillion indexes.
Oh yeah.
Okay.
Yeah, it's not just S&P 500.
Exactly.
Which a lot of people, because of the first index fund, that's what they think of. We'll just buy the S&P 500.
We'll buy the Dow. We'll buy the S&P. We'll buy the NASDAQ. All of those indexes are covering parts of the market that are actually pretty small.
Mm-hmm.
Especially if you buy like a Dow fund. You know, the Dow Jones Industrial Average is a very limited number of stocks. It just may be the wrong spot to be in an allocation at a particular time. And people don't even consider that.
So for example, in the large cap space, right, you might say that the Russell 1000 is a better way to track, you know, what's going on in the economy as a gauge, because that's what we use these indexes for, really.
Absolutely.
Realistically.
Yeah.
that's more inclusive than the S&P 500, especially, more inclusive than the Dow.
Right.
But you might see a year where the Dow is down 15% and the Russell 1000 is down 20, and you go, well, I'm losing. Well, not all of these indexes their performance is not as well advertised, and really understanding what they are representing.
Yeah.
That broad level of knowledge is not there.
Yeah. And I kind of go back to this and I say, there's as much of an argument here about active being complicated and passive being simple. And I am going to argue, and I know we're kind of jumping ahead, but I am going to argue that it's not that simple.
Nothing is.
Right. And so, for folks to just, hang their hat on passive and say that, oh, I'll just put my money in there and index it and it'll be great. You cannot, you're humans, and humans have emotions, at least the good ones.
Yeah. It's easy for us to say, we say it all the time, separate emotions from money, but money is one of the most emotional things that we're tied to, because what goes along with our money is the work that we had to do to get the money, the things that we had to do. If it was losing a parent to get an inheritance and things, money is attached to emotion. For you to be able to just shut it off, it's the right thing to do if you can do it. If you're a robot, bleed robot, But
it doesn't work that way.
Yeah. So I guess let's cap this off with I think we've kind of hit it, but if you're just using a strictly indexing approach or strictly passive investing, forget outperformance, right? Also forget buffering any downside.
That's right. Yeah.
So
no pivoting.
So let's talk a little bit about practically, when one might make sense more than another. I looked at historical returns.
Sure.
I think that when you look at the last 15 or 20 years, go back to the last big financial crisis, and I'm not including COVID, because really that was short-lived. I mean, I'm not saying we're not dealing with consequences, but I mean, as far as the market's concerned,
sure.
Go back to the last big market event. Passive investing has won.
Yes.
Since the last big market sell-off. And when you go back really historically and you look at passive investing over the long haul, since Vanguard has been around, since they basically invented this approach,
right,
it has won long term.
Right.
And this is something we debate here all the time, because we're believers in active management. Yep. We're also believers in passive management.
We are.
But, active management in volatile times, that's really where active management can shine, because there's opportunities to buffer on the downside. There's opportunities to say, well, we know they're not ringing a bell at the bottom, but we sold off 20%. So let's pivot, right? Let's take advantage of value and opportunities in the market where you can't do that with indexing necessarily. So the other thing I think when we look at historical returns is there are some sectors, and we're not going to get into the details on this, or even some indexes where, quite frankly, active managers never win.
Right.
The small cap space is really tough.
It's hard.
And you might look at that and say, well, okay, if 99% of fund managers can't beat the index, why not just own the index?
But even identifying the index is hard in that.
Well, true.
In that space.
But then you go to something like where historically lots of fund managers outperform are global large cap stocks.
Sure.
Why wouldn't you? So my whole thing here is you can marry the two ideas as part of your overall investment approach.
Right.
And so where you have opportunities to save money, where the index always wins, why not? But where you have opportunity to shield losses on the downside and take advantage of opportunities in the market on the upside, it's okay to pay good managers if they're returning more.
Yeah, I would agree with that. And I think that our approach has kind of always had that kind of tone to it.
It's a bit of a hybrid.
It is a hybrid approach. And that's why I'm saying, like my comments early, like I'm not going to set my feet firm in this principle and say that it's one or the other, because I just think that would be a mistake. And I would love to be able to convince all of our clients and every person that listens to this podcast to just, stay the course, pick an index that they can look at historically and they know that it's going to be okay. But like I said, the magnitude of the swings start to get bigger as you save more, which is again, it goes both ways. It's good, but I think it's just hard. I think it's hard to get through that.
Well, you don't look at percentages as much. You look at dollars. Right. And
that is common. That's super common.
Well, right.
Even our like performance stuff, you log in and it's like the big number, like,
oh, okay, we're only down 10 now.
Yeah.
Well,
10% of, $3 million is a lot of money.
It hurts.
And it's a lot of money for $100,000.
Right.
I mean, as a percentage of a lot of people's annual income, again, that emotion is very difficult to manage. And I wish there was like because I think this argument is much about how you can get through those times and less about like the actual managing part. And I know you would agree with the statement. I would have our clients 100% equities all the time if I could get them through, time periods like we've had this year.
Yeah. We manage more than money, though. We manage emotions.
Right. And I don't want them, throwing mama from the train.
Sometimes we are well-compensated guidance counselors.
Yeah.
And that's not to say guidance counselors don't do well, because I think they probably do all right, many of them.
Yeah.
But a lot of times that's what we turn into.
Yeah, psychologists, whatever.
Right.
I mean, and it's amazing to me that, when people ask me, how do you sleep at night when you go through periods of time like this? And it always comes back to me, to the stats.
Yeah.
And, certain areas of the market I'm very, very confident in long term. And passive works for those areas, no doubt.
Yep.
There are areas of the market that I'm far more skeptical of.
Yeah.
And I feel like, doing a little bit of scrubbing, and, we might get less return than an index for a period of time, but we might get greater for a period of time. But it's kind of helping get through some of those swings, I think, is really the key.
And I don't think it's shocking to say that in periods of volatility, like we've been in for a while now, this shouldn't shock anybody to think that good, old-fashioned, fundamental stock picking should perform well, right?
Yeah, I mean, that's like, go look and see the quality of the company balance sheet-wise.
The question is that people who are saying that this is what they're doing, are they actually doing it? Are they actually picking the good, are they finding the diamonds in the rough? Are they?
I will argue that all day long, because I have not, in my time as a financial advisor, former recovering stockbroker, I've never met that person ever. So hundreds and hundreds and probably thousands of people I've met, they're not out there.
Yeah.
So,
but it always makes sense to buy good stuff at a discount, right?
Absolutely. Always.
So I think there you have it.
This was a little deep.
It was a little bit tedious even, but we've talked a lot about this. It is. So, we believe in both approaches, and I think you can marry them together. You can use a hybrid of sorts. Again, I think I'll go back to what we're managing here. It's not just money, it's emotions. And if we can't get the clients to the finish line, we haven't done our job.
That's right. That's right.
And we want to be opportunistic as well.
If you feel that indigestion, boiling up inside, you probably should seek some good advice.
Definitely.
So, yeah.
Well, that's enough of that.
Yeah.
Thanks for having a drink with us this week, folks. Go ahead. I'm sorry.
It was tedious to get through this drink, I'm just going to say.
Yeah, there's a theme.
Oh.
It's time to close out the tab. If you have a question or a topic you want addressed on the Old Fashioned Finance podcast, be sure to email us at podcast@bluejfg.com. We'd love to hear from you. Don't forget to share the show with someone you love or just someone who needs a little money muddling themselves. You can stay up to date with the latest action by following us on Facebook. Old Fashioned Finance is brought to you by Blue Jay Financial Group, that's bluejfg.com, and produced by Podastery Studios. We've been your hosts, Caleb and Jason. Cheers.
Cheers. Yeah.
Blue Jay Financial Group, LLC. Blue Jay is a registered investment advisor registered with the state of Ohio. Registration does not imply a certain level of skill or training. The presence of this advertisement on this podcast shall not be directly or indirectly interpreted as a solicitation of investment advisory services to persons of another jurisdiction unless otherwise permitted by statute. Follow-up or individualized responses to a consumer in a particular state by Blue Jay and the rendering of personalized investment advice for compensation shall not be made without first complying with jurisdiction requirements or pursuant an applicable state exemption. All verbal and written consent on this presentation is for information purposes only. Opinions expressed herein are solely those of Blue Jay unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.